Hi, my name's Adam. Welcome to the channel. Thank you for joining us today. Today we're going to talk about a tax strategy that many of you watching this video need to implement. And you're delaying it. It's costing you tens to, for some of you, hundreds of thousands of dollars. And so hopefully what I break down in this video is going to help you, A, put more money back in your pocket, but B, give less money to CRA, which we're all trying to do in any retirement tax plan. So this tax issue pops up when you have a non-registered investment account. And what a non-registered investment account for most of you is, you've maxed out your RSPs or put money in RSP, you've maxed out your TFSA if you can have one, and you're left with extra money to invest. And typically you invest that in a non-registered or a cash account. And that might be held in your name, you and your spouse or common law partner. It could be a joint or individual. But at the end of the day, it's an investment account that creates a taxable income every year on interest and dividends or any capital gains generated. So it's an account that generates a tax bill on an annual basis. Now, when we put together financial plans for people, a lot of the time, the non-registered investments are going to be left to the next generation. It might be somewhat used, but a lot of it typically is going to be passed on to the next generation. And what we see happen time and time and time again, and this might be you, this might be your parents, this might be your grandparents that fall into this category. Have the conversation. I know a lot of you don't like to have that open conversation about finances at the dinner table, but next time you get together for a gathering, if you know you have a family member, whoever it is, has a bit more money than the rest and maybe has a non-registered investment account that they may never use, pass on this video to them or have this discussion with them in that, look, that non-registered investment account is a tax liability. It's generating taxes for them every year. It drives up their income. It potentially claws back old age security. There's not a lot of benefit to them having it if they plan to pass it on eventually anyway. Now, let's fast forward to the point when they pass away. When they pass away, as we know in Canada, there's no inheritance tax. So that money, let's say it's $1 million, would pass to the beneficiaries, which is great. But what about if you started passing that money earlier? It does a few things. Number one, it reduces the tax bill of the person that currently has that investment account. Because like I said, let's say it's $1 million and it's generating between interest and dividends and capital gains, like $50,000 in income every year. That we can now reduce and maybe get some of that OAS back and just reduce the overall tax bill. Secondly, passing some of that money on to kids, grandkids, whoever it is, not only reduces the tax bill for the current account holder, but it's helping that next generation or two generations down. It's paying off mortgages, it's helping through education, it's doing a lot of things that maybe that person has debt on. You know, instead of paying tax at maybe 30, 40, 50% tax rate, we can pass that money on. That money can be used to maybe pay down a mortgage. That mortgage rates are now up to 5, 6, 7%. That's a big swing. So when you talk about helping out the next generation, if the money is earmarked for that next generation, why not give it to them earlier? And this is always the problem I've had with inheritances. That money, when inheritance happens, typically it goes from, let's say, a 90-year-old to a 70-year-old. And that 70-year-old, if they've done proper planning, they don't need that money. And then they hold on to it until they're 90 and they pass it to their 70-year-old kids or whatever it is. And it's this nasty cycle that helps nobody. So either skip a generation or two generations potentially, or start giving your money away earlier. And if you fall into this camp, or maybe you have a parent, and why this topic came up, I've come across it many times. I had a financial plan review with a client today, and we were just chatting, and she said, look, my parents kind of fall into this category where they have money, they're gonna pass it on, they're being taxed on it, like what should they do? So we had this open conversation. I thought, you know what, I know her parents aren't the only ones because we've seen it many times over. There's a lot of you watching this video that, again, it might be you, it's probably your parents even, that are older, that are gonna pass money to you or your kids. It's a generational wealth transfer, but it's happening too late. So let's start speeding up that process. Again, there's multiple benefits to this. Reducing their tax bill, maybe getting some old age security back, and then fast forward a bit more, it's helping that next generation or beyond pay off the mortgage that currently is at a high interest rate, helping them through school, you know, paying for kids' education, whatever it is. There's many expenses when you're under 50. And you hit a point, and maybe you're watching this video and remember that, where you went from like mortgage and kids and expenses, and it was crazy, to kids are out of the house, income goes up, mortgage goes away, and all of a sudden there's a lot of free cash flow. You think of inheritance a little bit differently, like you don't need it as much anymore. Remember that younger generation still needs it. Not everyone, but a lot of them do. And again, if it's gonna pass them anyway, look to pass it to them earlier because it's helping you and it's helping them. If you're not sure how this would all map out, reach out to us. We can put a financial plan together for you. You can learn more about that service at parallelwealth.com/planning. This typically is people 75 plus. You're at a point in life where you know you're not going to use all your money and you need to start winding that down. The other issue that a lot of people have, and again, my clients' parents have, is they're in their 80s and they still have a boatload of RSPs or RIFs at that point. And that's where probably putting a financial plan together for those people, even though they're older, so it's a different, goal with those plans. It's more generational estate planning with those plans. There's still a plan that needs to be done for any person at any age. Again, when you're younger, it's more about how do I not go into debt and save money for a home and do that and pay the kids and build up my career and all that. That's kind of phase one. Phase two, again, is that transition of kids are leaving the house or my mortgage is being paid off or a bit of both. Phase three is hitting retirement. Phase four is really that later time where, look, like you're not spending as much anymore. You kind of know what your expenses are probably for the rest of your life on the most part, other than maybe a care facility. But you have a pretty good handle and you're going to have extra money to pass on. Look to pass it on earlier. It's going to help you. It's going to help the people that you're passing it on to. So hopefully this helps out. Again, it may not be you, but I guarantee it's someone around you that could use this advice, so pass it on to them. We do appreciate it. Thank you for joining us in this video, and we'll see you in the next one.